Procter Gamble is known as a fantastic compounder. The stock has always only went up, plus it has paid a nice dividend. It has usually always increased this one. Let's look at Procter Gamble. Is it a buy? Would I add it to my portfolio? Procter Gamble makes thousands of products. They have a lot of premium brands, Head & Shoulders, Gillette, Venus, Oral-B. These are all name brands which are usually in the higher price segment. But when we look at the revenue, we can see it has not grown a lot. Since 2013, inflation adjusted, it has basically declined, and only since 2017, 2016, it has started really growing considerably. We can also see this in the growth rate. During the pandemic, it has grown a bit faster, but that is mostly due to inflation. But when we look at their free cash flow has significantly improved since 2013. Especially until 2021, it has grown a lot. Well, their margins have greatly improved, from 11% up to 21%. Now, the only issue with companies which only grow via margins is that eventually there is a margin ceiling. Yes, it's great if you can raise your margin, but it is not great if it's the only thing you can do. Because while you may be able to achieve a 21% margin on products, but if you want to keep growing like this, in 7 years they improved by around 10%. If they would want to grow free cash flow at the same rate, they would have to double the margin again to 40%. And eventually we can't come as a ceiling. You can't make more than 100% on a product, and even that's not gonna happen. So obviously there's a ceiling on this. This is something I don't like. And especially when we look at the gross profit, so what they basically make after the cost of a product that they sold has basically not grown at all. We can see their gross margin has stayed always the same. So if their gross profit hasn't risen, that means expenses have fallen. Marketing, administration, and everything like that has fallen since 2013. And since 2015 have grown way less than revenue. They have not achieved more free cash flow by growing rapidly. No, they have just basically cut costs down. Which is one way to grow, but there's a limit to how much cost you can cut. Plus, the little growth they have is not always internal. They basically make an acquisition every year. Sometimes it's rather big, sometimes it's rather small. But on average, they spend around 1 billion per year in acquisitions. Now you would say, how much is that? Well, we can see per year they make 10 to 13 billion in free cash flow. So let's say around 8 to 10% of free cash flow is spent on acquisitions. And when I see that they're doing $1 billion in acquisitions each year, revenue only growing this slow is concerning to me. Of course, it's Procter Gamble. They're already huge. They don't have much more to grow. People say, yes, they can grow in Latin America, in China, in India, and Africa. Because that is true. Europe and North America make up 70% of our revenue. But that has always been the case for Procter Gamble. Everyone said, oh, but they can grow so much in Africa, in Asia, in South America. Well, they haven't achieved the growth there. Well, that is just speculation in my opinion. One thing you gotta give to the stock is that they're buying back shares always. They buy back around 3% usually per year, plus of course the nice and growing dividend. Even if revenue is not growing or fast growing, you will make some money just from the buybacks and the dividend. Question is, how much can they increase that? If we look what they put into dividends and share buybacks each year, last year around 14 billion. Well, free cash flow was less than 14 billion. Year before, over 16 billion. Free cash flow was less than 16 billion. Year before, 17 billion. Was less than 17 billion for cash flow. You can see what's happening. The company overspends, so they take on a lot of debt. Since 2016, debt has increased by 10 billion. That is still manageable for the company. They have not a high debt load, but basically this company, all the money they have, they spend on share buybacks, on dividends, and some more, and then they buy other companies, which also cost more cash, so they take on more debt. Now yes, free cash flow per share has risen greatly, but when I look at analyst projections, so what is priced into the stock, they just project revenue to keep on growing like it did during the pandemic. 6%, 3%, 4%, 4%, 5%. They have only achieved these growth numbers during the pandemic, and that was with extremely high inflation. I don't really see how Procter & Gamble will keep these growth rates up. They will buy back some shares, they will pay a nice dividend, but the growth rate on revenue will be between 1 to 3%, in line with the global economy, and especially Europe and the US. And the stock is not really trading cheap right now. The free cash flow yield is at 4.11%, and it has been constantly declining. Even the dividend yield has fallen. And that is what Procter & Gamble is, a dividend company. They're a mature blue chip company, which is not going to have a lot of growth. There's nothing wrong with that, but the dividend yield should be higher on those types of companies. Now, am I saying that makes it not a buy? And no, maybe it is fairly priced for value, but it immediately is a red flag to me. Let's say free cash flow continues to recover a bit more. It will be at 6.5 per share. Now, if we take those 6.5 free cash flow per share, what would be our normal scenario here? Revenue growth in the past without inflation, it was declining, and if it wasn't declining, it was growing at 1 to 2%. Let's say the company's gonna grow revenue at 3%. That includes the 1 billion per year in acquisitions and just natural revenue growth. And then let's add another 2% in buybacks on that. Sure, They often did maybe 3% in buybacks, but they're doing this by taking on more and more debt. Eventually that will have to stop, so let's say 2% to be more conservative. Some slowdown in revenue growth after 5 more years. 17 multiple, yes, it is trading way higher right now, but it is just not a fast grower, it is a dividend stock. I don't know why it's so highly valued. I'm gonna be conservative. 60% payout ratio with a little deduction due to taxes. They always basically have a 60% payout ratio, and we would come out to a valuation of $90 a share. It's currently trading at 150. That's not good. What if revenue growth is gonna be maybe 4% and we're gonna do 3% in buybacks? Slight slowdown to 3% growth after the next 5 years. 20 multiple, close to what it is today. But then we would come to 118, still not even close to our current value. What if it goes slightly worse? Not even bad. 4% growth for the next 5 years. 3% after that. 15 multiple. But then we would come to $77 a share. And this is not even the worst case scenario. What if it goes to just buybacks? No revenue growth. It was like that during some time. Still a 50 multiple would be very high, but it would only be $68 a share. So overall, I don't really see where the upside in this company is. I'm gonna pass on this. I'm not even gonna put it on my watch list. What do you think? Write it down below. Have a good day.